Hey everyone, welcome back to strategicwealthbuilder.com, the live show. I'm David Edwards, and I'm here with Scott Christensen, founder and CEO of strategicwealthbuilder.com, where we focus on personal finance and helping you achieve financial freedom. Today, we have an exciting topic to discuss, which is how using a whole life insurance policy can actually help get you out of debt. And when I first heard this, I thought, man, that's really interesting. So we're going to cover first the benefits of whole life insurance and how you can leverage its features to tackle your debt head on. So if you're struggling with debt and looking for innovative solution, this video is exactly for you. But before we dive into how to use whole life insurance to get out of debt, I'm going to ask Scott, can you tell us a little bit about how whole life works, and so they can understand this a little bit better?
Whole life is a very unique and interesting financial instrument. And as I've said in previous videos, it's quite misunderstood. And there's a lot of myths and misconceptions about how whole life works. But to start out with, whole life is, some people call it permanent insurance. There's actually 2 or 3 different types of permanent insurance, or insurance that develops what's called cash values. Cash values are the accumulations inside of a policy. But whole life is very unique in that it has a number of very significant and important features, such as guarantees, which many of the other cash value policies don't have. And there's another type of life insurance, term insurance, which is what most people have been, I shouldn't say most people, but a lot of people buy because they need a fair amount of insurance. It's generally the least expensive in terms of actual cash outlay to begin with. But over time, those dollars add up, and there's no cash value inside of a term policy. So if you don't pass away, the vast majority of plans, there's no refund. There's a couple of types of policies out there that are called return of premium, but by and large, they're more expensive than people want to pay for, and therefore they just choose the inexpensive term insurance. So the value of a whole life policy is some guarantees and the fact that it builds and develops cash value.
Okay, so kind of like the difference between purchasing a car and leasing a car, then, correct?
Although I'd say cars are kind of expensive, even the lease. It's cheaper than having a monthly payment, but not a lot cheaper. Term insurance in many cases is very inexpensive, and there is an absolute need for term insurance. Term insurance is a very important financial instrument in today's society. We've got to have access to low-cost term insurance so we can have the amounts of coverage that we need when and if that unfortunate event happens.
And I think that's the thing that's really important for people to understand is the fact that all these different financial instruments, these different types of insurance policies, they're all tools, right? And each person's individual circumstances are going to dictate what makes sense for them. Do they need a lot of death benefit? Do they need a combination of those things? And that's kind of what we do here at Strategic Wealth Builder. So I'm really curious though, Scott, can you tell our viewers, how in the world can I use a whole life policy to help get myself out of debt? That's interesting topic.
Yeah, David, there's actually a couple of ways to do it. First off is that if you have existing debt, then one of the things that we do is we go in, we take a look at all your cash flows. Where are there financial inefficiencies? In other words, money is not going in a positive direction for you. Mm-hmm. And by identifying those, sometimes we can redirect cash flow to start accelerating the debt elimination process. But ultimately, part of the challenge is that people go into debt because they don't have enough money to pay for current expenses or larger purchases. They need some furniture. They want to go on a trip. Whatever it happens to be, a lot of times they'll put it on credit cards. And then that's a way of financing things and paying for them over time. The challenge is that every dollar that you finance, every dollar that you put on a credit card, when you make that payment, all those dollars go to the financial institution. All the interest that you pay goes to the financial institution. These are what we call wealth transfers, money that leaves your checking account, never to return.
Right.
And you're losing all this interest. Well, what if you built up a capital reserve and could pay cash for things? Now, some people will say, well, yeah, but if I can get money at 2 or 3% to buy a car, why wouldn't I do that? And that may be a smart thing to do. But by and large, the vast majority of people that we work with, when we sit down with them, we find out where all their money's going. A lot of it is going to consumer expense and to consumer interest.
Right.
And if they would have paid cash for those items, they wouldn't have had the ongoing payment requirement, and they wouldn't have had an ongoing interest. And some of those interest rates on credit cards you're getting, they're crazy. I mean, we're talking 18, 20, 25, 27%. I mean, it's very, very financially damaging to have money on a credit card for very long. So by building up capital, if you build a capital account and pay cash for things, that solves part of the problem. But then there's the next part of the problem is we've got to recapitalize. We've got to recapitalize what we call the banking system. In fact, we have a terminology. It's called the family banking system. And what we're trying to do is help people understand that they could turn the tables, they could reverse the process in how things work in the financial world. You know, banks and credit card companies and finance companies, they are in the business of loaning money. And why do they loan money? Because they can make interest. They get to earn interest on it. They can charge interest. They set all the terms of the arrangement. They set the interest rate. They set the how long you have to pay it back and so forth. Well, you give up a lot of financial control when you're dealing with the financial institutions. So if you had the capability of paying cash or something, and then you did something very unique, and that unique thought process is this: what if you treated every expenditure that you had just like you had put it on a credit card? I was working with a couple here not too long ago, and we looked at all the dollars that they had put on their credit cards. And I said, now, if you want to get out of debt, there's a couple of things that we can do. And we were showing them how to rearrange their finances. And one of the things that I said to them, I said, listen, you have put yourself in debt to these financial institutions. You have nearly $100,000 between your home equity loan, your car loans, your credit cards and everything. You've got $100,000 in consumer debt. Now, if we redesign the cash flows, we're going to free up about $2,000 a month that was going towards all this debt. Now, part of it has to still continue to go to debt, but we're going to take some of that money and we're going to start building up a capital account so that in the future, when they have a major purchase, they're going to use the capital account to purchase it. But then we're going to teach them how to amortize it. In other words, create a monthly repayment schedule. We're going to have them charge themselves interest. This is a couple that was willing to pay 27% on one card, 22% on another, 24% on another. I mean, they had big debts, big interest rates, and it was crippling them financially. Well, I said, if you're willing to pay that kind of interest to a financial institution who they don't care about you. What if you looked at this capital account and you called it your family bank, and you treated it as if you actually took a loan from that bank and you paid yourself back with interest? How powerful would that be? So you're recapitalizing your account, this is what financial institutions do. They take your payments, lump them together, and go loan the money to somebody else. They're constantly revolving and recycling dollars. We want to teach you how to do that exact same thing, where you are constantly recycling and recapitalizing, and the interest that you pay, instead of going to a financial institution, is going to your banking system. Now, there's a lot more.
Think the way the banks think is what you're saying, right?
Exactly. And today we're not going to get into the details of how the family banking system can work, but I just want our listeners and our viewers to understand that this shift in thinking is one of the most powerful things that you could possibly do in changing your financial life, because you will now take control of your finances and you will begin to dictate how it goes for you. And that control, in fact, we teach people something, and I've referred to this in previous videos: liquidity, use, control, certainty, and enjoyment. Those 5 things: liquidity, use, control, certainty, and enjoyment. When you understand what that all means, when you understand the concepts behind each of those letters, each of those terms, when you understand that, you begin to have a much better chance of creating financial certainty for you going forward than any other process that you might encounter.
So you said it's LUCCE. Can you talk a little bit about how somebody would go about doing that, setting that up?
Yeah. So the first one, L, liquidity. And most of the things that we do with our money tie our money up. For example, you put money into a 401k, the money's tied up. Now, to a degree, it's supposed to be tied up so we don't use it. It's there for our retirement. But what about opportunities? What about this particular couple that I just talked about that had $100,000 in debt? They had about $150,000 in their 401ks. Now they could have used 50,000 of that. That's the maximum you can borrow out of your 401k. They could have borrowed that against or out of their 401k and paid down some of this high interest debt. Now the government, if you borrow money out of your 401k, you're required to pay it back. You're required to pay it back in 60 months, and you're required to pay it back at interest. Now, isn't that interesting? The federal government will let you borrow money from your retirement plan, but they make you pay it back. They set the term as to how long you have to pay it back, and they also dictate the interest. But
do you get that interest, or does the government give that interest?
Well, this is very interesting. You get the interest. This is the powerful thing. Our federal government has actually set up a system whereby you can accumulate cash in an account. Mm-hmm. It has some restrictions on it, but one of the positives is you can get some of the money out, but they make you pay yourself back with interest. And that's all we're sharing with people, but we're taking out the restrictions. We're taking the federal government out of the equation. But in this particular case, this couple could have taken $50,000 out of their 401k and paid off their 27% and their 22% credit cards and changed that dynamic significantly. But they hadn't done it. Now, this is a young couple. They're in their early 40s, 40 and 41, I think. And they're bright people. It's not that they're not smart. It's just that they don't understand how money really works, and no one's really helping them. And that's one of the things that we are trying to do, is help people understand how money works and how the financial institutions are using their knowledge of money and how it works to their advantage. We want to flip the table. We want to switch things around. We want to use the financial institutions to our advantage. We need checking accounts. We need savings accounts. We need all these other types of accounts. We need financial institutions, but let's use their tools for our advantage as opposed to theirs.
So basically it's getting a little bit more education on how these different tools work, looking at each individual's personal situation, and then figuring out how we can use those tools or add some new tools into the tool bag if we don't have some of those tools. You mentioned a little bit that like where and how you store your money is critical, and I think that's kind of what we were talking about. So can you continue on that?
Yeah, and that's a very good point, David, is that where and how we store our money is absolutely vital. It's critical. So for example, if we're storing money in a 401k, there's a couple of challenges there. One is we never know what the rate of return is going to be. We hope that it goes up, but we've seen over the last several years where market can be very volatile and we could actually lose money. So you can actually lose part of your retirement savings when the market goes down. Now, the hope is that it'll come back, but back in 1999, people thought they were in a good place to retire. 3 years later, there was no way they could retire. If they waited until 2008, once again, they got hit again, couldn't retire. 2022, market dropped 18%. So if you had $400,000 in your IRA, you just lost 20% of that, 18%. That's somewhere in the neighborhood of, what are you talking about, $60,000?
Yeah,
$57,000.
No, not.
The challenge is, in fact, I think it's nearly 80, as a matter of fact, $80,000. Well, that's one challenge. The other challenge is that money's never been taxed. And unfortunately, you have no idea what tax brackets you're going to be in the future. We ask people all the time, do you think taxes in the future are going to be higher or lower? And they almost always say it's going to be higher. If that's the case, then why would we want to defer our retirement dollars into a future where we're going to be taxed at a higher rate? Well, all those are, again, not saying that people shouldn't put money in a 401k, but we need to understand the financial inefficiencies of 401ks. And is there an alternative or the things that we teach are and processes, meaning you could have a 401k and you could have a whole life policy. You can have the things that you want. You can have the car, the boat, the vacations. You can have all those things. You don't have to scrimp and save every moment of every day just to make it financially. But what we do have is a system to teach people how to manage their money more effectively, more efficiently. We also show them how to eliminate and reduce the wealth transfers. And we also teach them how to make every dollar do more than one job, to create more benefits, multiple benefits, maximum benefits. So, this idea of having money in a whole life policy, which is what we started out this conversation about.
Right.
The thing about whole life is that there are many, many valuable, misunderstood parts to how a whole life policy can work. But one of the things that you can do with it is you can build capital up inside of it. When you build capital inside this insurance policy, it grows tax deferred. So there's no taxes of growth, but it can be withdrawn completely free from income tax. And as opposed to the 401k. So here's a place that you have money that is for opportunities, investments, purchases, and helping you get out of debt. Just like this couple that they've got this $150,000, $120,000 in their 401k, they were able to get $50,000 out, but there were strings attached to it. Well, what if you get the $50,000 out of a cash value account and you dictated the repayment schedule, which is exactly what you can do. You get to choose. And so over time, what we do is we transfer regular consumer debt that you incur to financial institutions, credit cards, car payments, et cetera, all those things that we finance, that we're paying somebody else the principal, we're paying somebody else the interest. We those dollars to a capital account that we create. And from that point forward, we are in control. We pay cash for things. We teach our clients to pay cash for things. We amortize them, the client charges themselves interest, and they pay money back into their family banking system, constantly recycling, constantly in control of how that money works. And the end result is you end up with a pile of money that you can use for future investments, future opportunities. And one of the cool things is down the road, for some of our older clients that are really building up and getting ready to retire, this is a source of tax-free retirement money. So we coined the term, transform your debt into wealth. So what we mean by that is take all the consumer debt that you will have, and let's redirect it through and run it through the family banking system. And when we run it through the family banking system, at the end of the day, we have more money, we have more control, and we have less tax and certainly less future tax liabilities.
So liquidity, use, control, certainty, and enjoyment. Lucky is what you were talking about, which I think is really interesting. And again, what we're really trying to get people to understand is it's just about taking the time to educate yourself a little bit more and being open to looking at things in a different way, having a different mindset. And with some little tweaks here and there, again, you're talking about this couple that had debt at 27%. I mean, think what that can do to building up that pool of capital if you're able to shift that 27% interest from going to EBC Bank into your own family banking system. And it's just going to be unbelievable difference down the road.
It really is life-changing. The concepts that we teach are literally financially life-changing. And, you know, I've said this before, I'll continue to say it. The economic future that we're living into is way different than anything we've experienced in the past. We are in a completely new financial paradigm that requires an entirely new way of thinking. So if we continue to do the things that we've done, we're not living into the last 40 years, we're living into the next 40 years, and everything is changing. There are so many factors. There's so many factors that people need to know and understand that they're not being taught through traditional financial planning channels. And that's what we want to do. In fact, we've created a website, strategicwealthbuilder.com. The viewers and the listeners can go on that. They can go there, they can click on the link below and go that. We have an entire financial educational library, lots of stuff that we've already got. We're going to be adding more stuff on a regular basis. We have a YouTube channel that you could subscribe to. There's another link that you can click on below this. And then one of the things that I've done recently is I wrote a book, and the book really was designed to help people get an idea of what some of these challenges are. I don't try to go into a lot of detail as to what you need to do to offset those. I just wanted to make people aware. I wanted to make sure that they understood that this economic future is different, and here's the challenges and the obstacles. And so if people would like to get a copy of my book, it's called Financial Certainty for Life. I got to figure out which way I'm putting this on the camera. Financial Certainty for Life, okay? Financial Certainty for Life. If you click on the link below, we'll send the book out to you for free. We'll even pay for the shipping if you want to get a copy of this. And I'd love to have people get a copy and get more informed. And then last but not least, I believe there's another link underneath this that they can click on and schedule a free 30-minute, no obligation financial consultation. Tell us where you're at, where you're trying to get to, some of the challenges you're facing, and let us help you chart a course that will put you in control of your financial future. I would love to do that for all the listeners that are out there, because the future's it's going to be exciting. We're going to have some fun, but it's going to be challenging, and people need to know the things that they don't know that they don't know. They need to know the answers to those things that they think to be true about money that really aren't. They need to know the truth about money. So I'm looking forward to helping people.
Well, hey, I always appreciate getting on here with you, Scott, and having discussions. And yeah, check out the links below, and we'll see you on the next live show. Thanks for joining us today.
All right. Thanks, David.
Bye-bye.